In the last month, JEPQ and QYLD have fallen off a cliff with QQQ moving in tandem to the downside. Epic fail on the so-called call protection that you're supposed to get with the option strategy. This is what I warned you about in December, that when you buy a covered call ETF, you have all the downside, but you're capping your upside. It doesn't make any sense. And for those of you who think that the fake dividend that these things pay is going to save you, I got news for you. It ain't. Let's take a look at what's been going on with their price action and then talk about what might happen with the Nasdaq. I think the Nasdaq can easily go to 10 to 12,000, 10,000 to 12,000 if we hit the skids on a recession, which looks very likely. I've been warning about this for about a year. Looks like the chickens have come home to roost. So if you own these investments, you really want to pay attention here. You're not getting the downside protection that you thought you were going to get. You have all the downside of QQQ, the Nasdaq 100, and your upside is capped. If we get volatility and you get these nice jumps in the market and we start going back up, you're going to get called out with their option strategy. This is not a good investment. And for many of you, unfortunately, you thought that this was some way to get some extraordinary dividend yield, fake dividend yield. You're getting a return of your principal. You're going to learn a hard lesson if things get worse for these funds. In the last month, the Nasdaq 100 proxy ETF, QQQ, is down 10.71%. Global X Nasdaq 100 on price is down 10.8. JP Morgan JEPQ is down 10.18. Do you see any difference in the chart of the security prices? I don't. Where's the call protection? Here are the same three securities charted for total return over the last month. Looks like the same chart, doesn't it? JEPQ and QYLD had about a 1% cushion over the last month versus the QQQ ETF. Hardly downside protection, in my opinion. Let's say we have 3 more quarters like this, and you finish the year minus 40% on QQQ, which could easily happen. Then, if this continues, you would be minus 36% on JEPQ and QYLD, approximately. So maybe you're going to get 4% of downside protection throughout the year. Does that really get you excited? Being down 36% when the Qs are down 40 is hardly downside protection, in my opinion. The last time that we had a technology bubble implode was 2000 to 2003, right here. And during this time frame, the Nasdaq lost almost 80%. That's a lot of money to lose, and you can see that it took about 15 years before it recovered break-even price. We could easily see the Nasdaq fall down to this 10 to 12,000 range. Could happen in the blink of an eye. It seems like right now a recession is in the cards. If that happens, you better believe that the Magnificent Seven is going to roll over, and it can get a lot worse from here. You'll lose so much money so fast in JEPQ and QYLD, you won't know what happened. It'll be over before it even started. You'll be caught off guard, and then what will you do? The so-called high dividends that you're receiving off of these funds are not really dividends. They're labeled as a return of capital, and that's why you don't pay tax on it. It's not true income. It's just a distribution. And that is why you don't see great performance on the total return graph. If you were really getting a 13+% dividend on QYLD, you'd see a lot better performance when you chart the total return graph over time versus the QQQ. But that's not the case. Again, I want to emphasize, with these ETFs, you have all the downside, potentially more downside. There's something else to consider. These funds have the capability to do worse than the underlying index. You might not get any call protection whatsoever. You might even do worse than the index. So if you're owning these funds as some sort of income producing vehicle, this is your wake-up call. you can not only lose a lot of your money, but that income isn't really income. Ask yourself this question: does it make sense to put your capital at risk of a massive loss and limit your upside? What sense does that make, especially if you are a retiree? Unfortunately, too many of you have reached out to me, and I've met a number of people who own these investments or similar covered call right funds, and you are completely unprepared for what happens in a real downturn. The wind has been at our backs for 16 years. We've been in a tremendous bull market. But when we enter recession, which we may be entering recession right now, funds like JEPQ and QYLD can lose a lot of money. And if you are using this type of investment for some type of income strategy, I think you're going to be very, very disappointed. JEPQ and QYLD do have the potential to make you money in the long run. I don't want to lose sight of that. These investments can definitely make you money if you have a 10-year or longer horizon. But I don't think they're a good income solution. And you want to be really careful with that. I think the big danger here is that a lot of people just haven't experienced a 40, 50, 60% loss on their capital. So if you're heavily concentrated in call right funds that are in aggressive underlying investments like JEPQ and QYLD are, you might lose a lot of money. How will you feel if you see, for example, half or more of your portfolio eviscerated? Some people panic and then they sell. I've seen it happen many times. I saw it in 2002. I saw it in 2008, dozens of times. Smart people, all kinds of people, they get scared. They see their portfolio go down. Then their feelings change and suddenly they hit the panic button. That's my fear for all of you that own QYLD and JEPQ now. When you see real losses as we move forward and maybe no recovery, what are you going to do? If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.